Hello everybody and welcome to another webinar. This week I'm really delighted to be joined by Tarryn. Tarryn is going to be presenting this live class, which is entitled Understanding Financial Statements. I don't understand financial statements particularly well, so I'm really excited to hear what Tarryn has to say. It should be very educational for me and hopefully for everybody else. Tarryn is extremely well qualified. She graduated with a Bachelor of Science majoring in Physics and Astrophysics in 1999, a Bachelor of Commerce in Accounting in 2001. She has just a flurry of qualifications, too many to say here now. She's worked with the financial services industry in a variety of roles, including investment research, portfolio management, systems implementation, business development and operations in Cape Town and London for the past 15 years. I'm really delighted to welcome Tarryn. I've spoken briefly with her before and I think you're in for a really great live class. So without further ado, I think I shall pass on to Tarryn, who can take you in from here on out. If anybody has any questions, please do go ahead and just pop those in the questions box. And we'll try our very best to get to them by the end, and if not, we can always get back to you by email. Also, for a recording of this webinar, since that's a very common question, might as well say at the start, if you just send an email to info@webinarsteam.com, that's info@webinarsteam.com, we'll look to get the live class uploaded as soon as we edit it and get it sorted in the coming days, and we can then send you a link out and you can rewatch to figure out anything that you wanted to take another look at. So yeah, without further ado, thank you very much guys, and thanks to Tarryn in advance. So welcome Tarryn.
Thanks very much. I'm really excited to be here. I understand that for many people the thought of accounting is rather daunting. A lot of people, when faced with spreadsheets and numbers and such things, tend to freeze up. So the objective here is not to turn anybody into accountants, but to just give you a sort of a high-level overview that maybe just piques your interest and maybe lets you go and have a conversation with somebody who does your bookkeeping or accounting with a little bit more knowledge of what it is they do and what sort of questions you should be asking and looking for on annual financial statements. So we're really going to look at the flow of the accounting cycle and how that then culminates in annual financial statements and what annual financial statements tell us about a business. Now, accounting is really a series of recording and aggregating information. And accountants are never actually done. Although we produce financial statements at the end of a period, sometimes at the end of a quarter, definitely at the end of a year, certainly for public companies, that is absolutely mandatory and dependent on your jurisdiction. The regulations will require different statement production. But the job is never done, because if a business is a going concern, there are always transactions, and every transaction has to be recorded. And those recorded transactions are then aggregated into ledgers, and sometimes we produce management accounts that are helpful to look at, perhaps on a monthly basis, to keep a finger on the pulse of the business. And those ledgers are consolidated and collapsed into a trial balance, and then we do all sorts of fancy year-end adjustments which get quite technical. We take part in a budgeting process so that we know where the business is headed over the following year. And then we produce the sort of final glossy set of documents, the annual financial statements that need to be signed off by various people. And then we start again. And in fact, during the production of the annual financial statements, which typically happens only after the year end of the business, the transactional cycle hasn't stopped. So there's never a pause in the accounting cycle. It's this sort of perpetual information machine. So an accountant's job or a bookkeeper's job is never actually done. They can never say, that project is now behind me and I can move on. So let's understand what recording transactions are all about. Well, Every transaction within a business must be recorded, and this is irrespective of the nature of the transaction. So if you're buying groceries for the canteen, milk and tea bags and coffee and sugar, or you're purchasing some enormously expensive piece of equipment, it doesn't matter on the kind of the size of the transaction. If there has been some sort of transactional flow within the business, we have to keep a note of it. We have to track absolutely everything, which I know sounds very pedantic, but unfortunately is necessary. The other part of a transaction is that we must be able to back it up with some sort of source document. Now, if anybody's ever worked in some sort of big corporate and you've got your accounts department that get very agitated with you when you don't submit your slips from your coffees and lunches that perhaps you've had with clients, or you paid for some photocopying and you don't have a slip and you're trying to reclaim those expenses or travel expenses, and they get very demanding that you must have filled out your form correctly and you must have your slip correctly. It's because every transaction that they record has to be backed up by some kind of source document. So we have to have an invoice, a till slip, a delivery note, so an employment contract, something that an external party can say, okay, I understand why you've recorded that transaction. I understand the source of that transaction. Now, when we record transactions, what we don't want is just an absolute sort of muddle of information. So the first thing we need to do is start to understand the accounting framework. How do we now classify all these transactions that the business is making, from buying the milk to buying the delivery vehicle? How do we sort of fit these things together so that the information starts to make sense when we look at it as a whole? Well, accounting has three major categories into which we classify our transactions. Transactions are either lumped as equity, as assets, or as liabilities. And let's just talk about what those three classifications or categories mean. Now, equity is this notion of the claim that the owners have on the business. Now, this could be a massive public company where the owners are hundreds of thousands of individual shareholders, or it could be a small private business or a startup where maybe there's one or two shareholders. But the equity is representative of the claim that these owners have on the business, and it's what do we have left once we've settled all our obligations. That's the equity, is the missing piece of the puzzle. Now, when we think about the type of transactions that we make, certain of these transactions we understand are expenses to the business, buying milk, buying photocopy machines, buying office chairs, those kind of things, paying for office rent. Now, when we process transactions that are expenses, they reduce the equity of the business. So the owners have less of the business left because the business has paid out these expenses. And conversely, when we sell products or services, so we have revenue coming in and ultimately profits, those type of transactions increase the equity of the business. So when we talk about equity, it's sort of how much is the business worth and how much do the shareholders have of that business. So let's now look at assets. Assets are the things that the business owns that are used in the production of income. That's the sort of real standard classification of what an asset is. So assets are quite wide-ranging. We can think of property, which I think comes naturally to us as an asset, or equipment, or vehicles. But the other things that are assets are things like inventory, our stock that we might sell, or cash that we have. We also have this concept of debtors. Now, some of you may be more familiar with the term accounts receivable or debtors. These are people that have bought goods from us that owe us money. That is an asset. We may have patents and copyrights. Those are also all seen as assets. They are used by the business in the production of income. Now, the converse of assets are liabilities. Now, liabilities are future obligation that the business must pay. So we owe somebody out there some money, and we probably all understand the concept of a personal overdraft, where we've used our credit card, and we know that we are liable for that money to the bank. We have to pay it. We have loans that the business may take out. Perhaps they've financed a vehicle. Perhaps they've financed the purchase of their factory. These are future obligations that flow out of the business. So those are the three major categories: equity, assets, liabilities. And that's how we sort of start the framework of recording transactions. Now when we record transactions, we don't just sort of write it down on a piece of paper. What they actually called are journal entries. So every time there's a transaction, there has to be a corresponding journal entry. And journal entries follow these two key rules. And we won't get too technical on this, but we just give a sort of high-level overview. The key rules are that for every debit, there must be a corresponding credit, and we'll explain a little more what that means. And this notion that the accounting equation must hold. I don't want people to get freaked out by the thought of an equation in accounting, but it's really just saying that, and we've got it down there, the equity of the business can be written as the assets of the business, so what the business owns, less the liabilities, what the business owes. So that we understand as a concept of equity, and we can write that equation in a couple of different ways, and if people sort of hark back to their high school algebra, they'll understand that we can rearrange equations, and we can also write it, as we will see on our balance sheet, that equities equals our assets plus our liabilities. Okay, so let's have a look at what debits and credits actually mean. And this is when accounting students, typically for the first time they see this, they typically have a little bit of a frenzy and they don't quite know what they're going to do. And when I'm dealing with first-year accounting students, this table that you see before you, typically I get them to write it out and put it on a post-it note and stick it on their fridge and stick it on their computer monitor and stick it on their dashboard of their car, because it's confusing. It's not an intuitive system. But let's have a look at what this all means. Let me get a pen so I can do some scribbling as well. So here are our three classes that or categories that we've talked about: our equity, our assets, and our liabilities. Now, the notion of debit and credit in accounting terms is really just saying, are we increasing or are we decreasing? And now here comes the tricky bit. When we increase equity, it is a credit transaction, and when we decrease equity, it's a debit transaction. That sort of makes sense to us. Here is the outlier, our asset category. When we increase assets, we actually record that as a debit, and when we decrease assets, we record it as a credit. And then liabilities behaves a little better. When we increase liabilities, we credit, and when we decrease liabilities, we debit. Okay, so no need to think about that too hard, but just to understand that when accountants talk about debits and credits, they're really talking about increases and decreases, but we've also got to know whether they're talking about equity or assets or liabilities to understand whether when they say debit they mean increase in the case of assets, or when they say debit they mean decrease in the case of equities. Let's have a look at an example of how this might look. So let's say we are a design company and we design a logo for a new business, and the customer pays us $500 in cash for designing this logo. So we know we've received income and we know we've got some cash in our wallet, which are good things. So how would we record this? Because this is now a transaction that's happened in the business. How would we record this in the form of a journal entry? Well, we know that bank is a form of asset, and we know that we've got more of that asset because we've got some cash. So when we want to increase our asset, it is a debit. So we would say debit bank, and we know that we've received income because we've sold our services, our design services, and we understand that income affects our equity category, and when we want to increase our equity category, it is a credit. And so what we've got is a debit to our bank, increasing our bank by 500 Rand, and a credit to our service income, increasing that by 500 Rand. And these two things together are a journal entry. And each time there is a transaction, we will have this double-sided, so it's got sort of two legs to it, a double-sided journal entry that classifies which categories are increasing and decreasing given that transaction. So let's look at another one. Let's assume that we buy a new delivery vehicle for $9,000, but we don't have the cash to pay for it, so we take out a loan from the vehicle financing company to pay for that vehicle. So our vehicle arrives, there it is, in our parking lot. It's ours. It's an asset that we're going to use in the production of business income. When our assets increase, it is a debit transaction. But now let's think about how we've paid for the vehicle. We haven't taken cash out of our bank account to pay for it. We've borrowed the money. And we know that if we borrow the money, at some point, whoever we've borrowed from is going to want that back. So we have a future obligation to pay. So that means it is a liability. And we have now increased our liabilities. We've increased our obligations. And when we increase liabilities, we have a credit transaction. So here again, the two legs to our journal entry. One is a debit, and that's vehicles. And we look at that and we say, okay, debit vehicles. Vehicles is an asset. Debit in an asset sense means increasing, so we've got the vehicle. Credit vehicle loan. A loan is a liability. When we credit a liability, it's increasing, so we know that we've got an asset in and we've got a liability. And again, that pair together constitutes a journal entry. And so every single transaction, and again, going back to buying the milk, buying the printers, buying the paper for the printers, buying the ink for the printers, all of those are transactions, and every single one of those will be recorded as a journal entry, which will have two components to it to reflect exactly what is happening with that transaction. Now you can think in some businesses, maybe the transactional volume is quite low, but there are other businesses where there are quite literally thousands of journal entries that are recorded over the course of the month and hundreds of thousands that are recorded over the course of the year. So you can understand why in a big transactionally heavy company you actually have a lot of staff in the accounting department keeping track of every single one of these transactions and making sure that these journal entries are correctly recorded. Right, let me just take a moment to get rid of my scribbles. There we go, and move on to the next slide. Now, assume that we'd been doing this. We had a whole laundry list of entries. We had debits and credits of different things that the business had done. That mess of information by itself is not very helpful. We can't really get a sense of what's happening in the business just by looking at our general journal, which has all of our journal entries in. But luckily in this day and age, we've got accounting software. And accounting software quite easily turns journal entries into what are called individual ledger accounts. So this is where we look at just our bank account, or just our income account, or just our vehicles. And then we can get a snapshot of what's going on. So in this case, when we look through these journal entries, which have been turned into ledger accounts, we can see that we had service income, and if we look down, we had some more service income. So here it is in our service income account, and we can understand exactly how much, what our total of service income was. It was 1,750, and when we look at our bank account, we know that the money came into our bank account. There it is coming in. And we have a look down here and we see we had a telephone expense. Now we understand that when we have an expense in the business, it reduces our equity, and also we would have paid it, so we would have taken money out of the bank account. And there's the money coming out the bank account to leave us with a bank account total. So what we've done is collapse journal entries into ledgers to start giving us a bit more meaningful information. And let's see what the next step is. Right, so ledger accounts by themselves, quite interesting. You know, we can have a look here and see, well, what income do we have, what expenses did we incur. So starting to become a bit more meaningful than just a mess of transactions, but still not great in terms of a summary of information across the business as a whole. So what happens next is that our ledgers get turned into what is called a trial balance. Now, a trial balance let's move this out the way, has a balance sheet section to it and an income statement section to it. And our trial balance, in fact, serves as our source document for our annual financial statements. So in the same way that we needed source documents to confirm our transactions, a till slip, an invoice, a credit note, we actually use a trial balance as our source document for our annual financial statement production. Now, what we do is we look at all our individual ledger accounts and we pull what is called the closing balance, so the kind of the grand total, if you like, the net of the ins and the outs, and we pull those items onto the trial balance, and there it is there. So we can see there's our bank. If we look, here's our vehicle asset, in it comes, and we do all of that. So we've got our telephone expenses, that should be 60, not 80, and we've got our income. And the important thing about a trial balance is that the sum of our debits must equal the sum of our credits, and that's kind of a nifty trick of accounting. And that is because we've done a good job at making sure that our debits equal our credits whenever we record a journal entry. So we have that double leg process. There's always a debit and always a credit leg to our journal entries. And so when we get to this situation here, we know that we've captured everything correctly. Our trial balance balances, and that's really, I guess, where the notion of a trial balance came from. So there it is. So that is now a little bit more helpful in that we're starting to organize our information into different sections that start giving us a picture of the business. Let me just erase some of my scribbling and we can move on. Okay, so now having gone from transactions through to recording our journal entries, and in order to record our journal entries, we've got to categorize into assets, into equity, into liabilities, and then we've got to decide whether those are increasing or decreasing, and use debits and credits appropriately to show whether it's an increase or decrease. And then we transform those transactions and journal entries into individual ledger accounts, and then we pull the balances of those ledger accounts into a trial balance, and that then leaves us ready to produce an annual financial statement. So there are four main parts to an annual financial statement pack, and if anybody's ever looked at annual financial statements, they tend to be, particularly for public companies, a fairly weighty document, and they will often be accompanied by all sorts of things up front, letters from the chairman, indications of strategy from the CEO, comments about the industry or the market, and they all look pretty glossy. A small company will have less of the gloss, but will certainly still have these four main items, which are a balance sheet, an income statement, a cash flow statement, and a statement of changes in equity. And then in addition to those four main documents, there's also always a pack of notes that accompany the financial statement. And that's because the financial statements by themselves don't give us quite enough information, and we need to be able to refer to extra detail in the financial statement notes. Right, so what do these things tell us? Well, a balance sheet tells us the position of the business on the balance sheet date, which is typically a quarter end or a financial year end. So it's sort of like a snapshot of business health. On the balance sheet, we break it into our three categories. We've got our assets, our liabilities, and our equity, which are reflected. And it is as at a particular date. Now, part of doing the sort of year-end process, if anybody's worked in any kind of retail industry, you'll be aware that at some point in the year, and typically towards a financial year end, you have to do a stock count. You have to go, and it's a tedious job, you have to go and quite literally count how much stock you have in your shop or in your warehouse. And that is because that number needs to actually be exact on the balance sheet date. So on that specific financial year-end date, we need to know exactly how much stock or inventory the business holds. And so that's why we undertake the stock count process. We also undertake it to make sure that our stock is not being pilfered by our employees or lost due to breakages or damage. So it's important for other ways, but we do need to have an accurate number because a balance sheet gives us a snapshot on a fixed date point in time. Now an income statement is a little different because the income statement shows us our income and our expenses over the accounting period. So if we consider that our year end is, call it the 28th of February, then our income statement will show us all the income and all the expenses that happen from the 1st of March, the first day of the new accounting period, through to the 28th of February, the last day of the accounting period. So we can see everything that came in and out of the business over that time period. Now the cash flow statement, as the sort of name suggests, deals simply with the movement of cash. We won't get into cash accounting versus accrual accounting now, but sometimes there are transactions that do not have a cash effect, like buying a vehicle on using finance. No cash has changed hands. So that would be an example of a non-cash transaction. But what the cash flow statement does is looks really just at cash in, cash out. And we break this up into operating, financing, and investing activities. And the final one is the statement of changes in equity. And that gives us information on whether shares were issued or redeemed or dividends paid. But the two main statements that we tend to look at are our balance sheet and our income statement. So let's have a look at what those look like. Okay, so let's start with the income statement. And what we can see is when we look at the header of that statement, we can see it's for the period, which basically means it's everything that's happened within that financial year. And in this case, what we start out with is the notion of revenue, or we could also call it turnover. It's essentially the money that has come into the business by virtue of us either selling goods, so we're a retailer and we sell clothing, and the revenue is what our customers have paid for us, or we're a type of business that supplies services, like we do design or architecture or legal services. That would still be revenue. It is what our business produces. It's our kind of reason for being that comes in. Then what we have is this concept of cost of goods sold. Now this pertains a little bit more to somebody that's selling goods rather than services. But if you think about it, if we are a merchant and we sell t-shirts, we've got to pay for those t-shirts. They cost us something. We don't just get them out of nowhere. And even if we've manufactured them ourselves, there's still a cost to each particular t-shirt. And what we need to do is sell the t-shirt for more than it cost us to make the t-shirt, which obviously makes sense. And that's how we generate what is called gross profit. So that's the first line item that's key. And a lot of people will look at some sort of gross profit percentage, which is how does our gross profit relate to our revenue. And this is an important number. So this tells us that before we've paid for any of our operating expenses, are we profitable? So our gross profit. Then the part that comes next on the income statement is called operating expenses. Now this is everything else that we need to pay for in order to stay in business. So if we've got telephone expenses, salaries and wages, rent, marketing expense, insurance, whatever else that we have expensed over the course of the financial period will turn up in here, all as part of our operating expenses. So these are the expenses we have to incur in order to be in business, in order to operate. And then what we do is we deduct these operating expenses from our gross profit. So we started with our revenue, we deducted our cost of goods sold to get a gross profit, then we deduct our operating expenses to get a concept of net profit. So we often call this net earnings before interest and tax. And when you speak to any kind of a financial market guru, if you watch CNBC or Bloomberg or something like that, you will often hear them talking about EBIT or sometimes EBITDA, which is earnings before interest and tax. And if we talk about EBITDA, it's earnings before interest, tax, and depreciation. So that's really what they're talking about. They're saying, well, how much profit before these sort of extra items, how much profit did the company make over the period? So we've got, as it states, before interest and tax. Now, interest expense comes off when we've bought something on finance. So part of the financial contract or part of the financing will mean that we have to incur some level of interest. So if we've got taken out a mortgage to buy a property or a bond to buy a property, we know that there's an interest component. If we've got an overdraft on our credit card, we also understand that we pay back the money we've borrowed, but there's also an interest component. And this is true for business as well. When they borrow money, there will be some sort of interest expense, which comes after our net earnings line item. So again, we've got to now deduct our interest expense because the money's gone. We've paid for it. It's an expense to the business. We deduct our interest expense from our EBIT to give us a net profit before tax. Then we have to work out our tax amount, and of course around the world tax rates are different, and typically we would get some tax advice on how best to compute and work out our tax to make it as sort of expeditious as possible. But typically a business is going to have to pay tax if it has made a profit. If it's made a loss, then we enter a whole different realm where we've got things like assessed losses and tax assets, and that starts to get complicated. But assume that we had a going concern business that paid, that made a profit, there would be some tax to pay. So we've got to deduct our tax from our net profit before tax to get our final net profit for the period. Now we hope that that is a positive number, because what it means is that our revenue has adequately covered our cost of goods, our operating expenses, our financing expenses in the form of interest, and our tax expenses. And we've got a net profit, and this is what the shareholders have a claim on, this net profit number. Now what we're going to do is turn our attention to the balance sheet. And the balance sheet and the income statement talk to each other, and I'll show you in a sec how they talk to each other. But essentially, as we discussed, our balance sheet is as at a particular date and time. So it's sort of a fixed snapshot of the business. And we break our balance sheet into our accounting categories. So we've got there our assets, and we lump together our equity and our liabilities into one sort of main section. And what we do on a balance sheet is list out everything that we own and list out everything that we owe. So when we list what we own, we're listing out our assets, and we add some further classifications, and we won't spend too much time on these, but we've got things called non-current assets, which are things like vehicles and property and plant and equipment, things that we're not going to realize, in other words, not going to sell or unlikely to sell within the next 12 months. They can't be converted to cash, or not, we don't intend to convert them to cash within the next 12 months. So these are our non-current assets, and we would write down everything that we own in terms of non-current assets. We've also then got current assets, and this is where our concept of inventory or stock, our debtors or accounts receivable, our bank, all form part of our current assets. And we would get a total for our current assets and a total for our non-current assets, and collectively they would tell us exactly how many assets, what the value of those assets is on the balance sheet date. Then we come down to our equity and liabilities section. Now in equity we've got two key items that typically turns up on the balance sheet. We've got shareholders' equity, which tends to be, particularly in a small business, tends to be what the business owners have put in to kickstart the business. So let's assume this is a fairly small business, it would mean that the business owners have put in $4,000 to get this business underway. And then what we have is this concept called retained earnings. And this is how the income statement and the balance sheet talk to each other. Because what happens is that the net profit after tax, this final result of our income statement computation, gets pulled onto the balance sheet under the line item retained earnings. And that's how the two statements link to each other. If you're looking at a balance sheet of a business that's been going for a while, then that retained earnings number will be the current year's net profit, so what we've made this year, plus any of the net profit or earnings that we have retained, so in other words, kept in the business, not paid out to our shareholders from the prior periods. So this is sort of the cumulative profits of the business that have been kept or retained in the business. And those two key items together make up the equity of the business. And then what we've got are our liabilities section. And like we split assets into non-current assets and current assets, we split liabilities into non-current liabilities and current liabilities. And again, we've got this sort of 12-month cutoff on these. So non-current liabilities we're unlikely to get rid of in their entirety within the next 12 months. Current liabilities we are likely to pay and settle within the next 12 months. So bank overdrafts and creditors form part of our current liabilities. And again, we would get a total for current liabilities and we would get a total for non-current liabilities. And then what we do, and if we remember our accounting equation, which said to us sort of early on that we could write it as assets equals equity, excuse my scribbling, and then we get a final O in here, plus liabilities. What we have is the balance sheet is a representation of this accounting equation because we have assets which we worked out. We added 35,500 of non-current assets plus our 14,500 of current assets. We added those together to get our total assets of $50,000. We do the same in that we add our equity and our liabilities, and look what happens. When we add our equity, $34,000 plus $10,000 of non-current liabilities plus $6,000 of current liabilities, we get $50,000. So our assets equals $50,000 equals our equity 34 plus our liabilities 10 plus 6. So $50,000, $50,000, our balance sheet also balances and our accounting equation holds and we know that we've done everything right along the way. So what do these financial statements tell us about the business? So it's all good and well to understand that we've gone from transactions to journal entries to ledgers to a trial balance all the way through to accounting statements, but what do we get out of this? So what are some of the key things to look for on accounting statements, on annual financial statements? So one of the first questions to look at is profitability, and we would go and have a look on the income statement for this. So is there a profit? Is that number at the end of the income statement, is it a positive number? Because that implies that we've made a profit. And now knowing that the income statement and the balance sheet are linked through this retained earnings line item, we go and look at the balance sheet and we say, well, how big is that retained earnings number? Because that's the cumulative profits from all our prior years of operation. So that's now already giving us a sense of whether the business is profitable in this year and whether the business has been profitable historically. Another key thing to look at is this concept of solvency. Now, a business must be solvent in order to be a going concern. In other words, a viable business that's not subject to any kind of bankruptcy law. So what does this mean? It means that our equity has got to exceed our debt. And I'm going to just go back one slide and let's have a look at what that means on our balance sheet. So in this case, our equity was 34,000 and our debt, which is our liabilities, our obligations, if we add that together, 10 plus 6 is 16,000. So in this case, our equity exceeds our liabilities. So our business is solvent. So what else do we have to look for? Well, another key thing to look for is this concept of liquidity. Now, solvency speaks to sort of the long-term viability of the business. Can the business service its long-term debt obligations? Liquidity has got a more sort of short-term time frame, which means do the current assets exceed the current liabilities? So in other words, what we've got that is sort of easy, liquid, cash-like assets, like cash, like inventory that we can sell, like debtors who owe us money and are going to pay quickly, can we use all of those things to easily settle our short-term borrowings? So again, let's have a look back. So what we've got here is that our current assets were $14,500 and our current liabilities was $6,000. So here our business has a situation where our current assets exceed our current liabilities. It means that this business is sufficiently liquid. If today the bank arrived and said, you've got to settle your bank overdraft today, and your creditors who you've bought goods from on credit said you've got to pay today, we would be able to find the money. We would have sufficient liquidity to settle those current liabilities, those current obligations almost instantly. And that's a good place to be as a business, to have overall solvency, very important, and to have sufficient liquidity to be able to settle your short-term debt. Now, we would never have a 24-hour turnaround period, but sort of over the typical payment cycle, we want our current assets to exceed our current liabilities. The other thing that we can look for, we didn't look at a cash flow statement because it starts getting a little bit technical, is we want to see that the business actually is cash flow positive. Now, we could have a situation where we've made lots and lots of sales. We've sold plenty of stuff, but it's all on credit. So in other words, our customers haven't paid us yet. So we could have a situation where the business has made lots of sales, we've got lots of revenue, we're profitable in the sense that all our masses of sales cover our expenses, but if we haven't yet collected the cash, that would show up on the cash flow statement because the cash receipts wouldn't be there. And we could have this funny situation where we've got lots of revenue, we're a profitable business, but we actually don't have much cash, and we don't have enough cash to settle our current obligations. And that also puts a lot of stress on a business, and something as simple as a poor cash collection policy can actually lead to bankruptcy in a business sense because their creditors get upset that they're not being paid, and that starts the bankruptcy cycle. So profitability important, solvency important, and short-term liquidity are all important. And that's information that we can get off those annual financial statements. The income statement, the balance sheet, and if we were looking at as well, the cash flow statement. Okay, so just in terms of a quick recap. All business transactions must be classified and recorded as journal entries. And we break those into three key categories: assets, liabilities, and equity. When we record our journal entries, our total debits must equal our total credits. Our journal entries have always got those two legs to them, a debit leg and a credit leg. And this concept of the accounting equation must hold. And we see that accounting equation in action on the balance sheet. We then summarize those journal entries into ledgers, and from ledgers we go to a trial balance. And we use that trial balance to prepare our annual financial statements. And that annual financial statement provides us with a standardized view of the health of the business. Now, the reason that it is standardized is so that I can look at the financial statements of any company and know that I'm getting a consistent view of the health of that company. Each company can't decide what to report and what not to report. It all fits within a standard accounting framework. So whether it's a potential investor in your company, a bank who's deciding whether to grant you credit for your company, an analyst who's reviewing your company, somebody who wants to buy the company outright, when they look at your financial statements, they're getting this consistent, standardized snapshot. And that is why financial statements and the production of financial statements is so important. But those financial statements are only as good as the journal entries that have been recorded through that accounting cycle. And that's really it for me for tonight. And I hope that's given you good things to think about and not being too daunting or overwhelming. I'm not sure if there are any questions, but if not, thanks very much for listening. And I look forward to being able to talk a little bit more about finance to you in the near future.
Thanks, Tarryn. That was brilliant. In terms of questions, I'm sure that there may be one or two. So if anybody wants to ask anything now, we have a few minutes left to field anything to Tarryn. So do please feel free. N Walsh. I'm not sure what the N is for, so I can only say Mr. or Mrs. Walsh. The email address, Nina Walsh. Hi, yeah, the email address that you need to send an email to me for the recording is info@webinarsteam.com. So it's webinar, webinarsteam.com. There was a question earlier on. You'll have to bear with me a little bit here, Tarryn. It's from Omar Mujika. Whether or not he can actually highlight exactly what he's referring to, or whether you'll understand it yourself, because you're much more expert, obviously, than I. He just asked, what about other types of revenues that are not part of the core of the company, such as investment revenues or rent revenues? I don't know what you... Oh, go ahead.
I'm going to answer. I do understand. That's a great question. Thank you. So when we looked at this income statement, and I'll just sort of flick back to it, and let's have a look. This is I guess, a pretty basic income statement that you would typically see on perhaps a retailer. If we had other revenue coming in, and we had rental income, interest income, investment revenue income, then what we would have is, after this gross profit line item here, we would insert our other income. And so we would get a sort of this is assuming that we still have cost of goods, and so we would have our revenue from selling our goods, then we'd have our costs of goods, and then we'd have our gross profit, and then we'd have our other income line items like rental income, interest income, those kind of things. And those would get sort of put in right near the top of that statement. We may have a situation where we don't, in fact, have cost of goods sold because we're really just a service-based business, in which case we would have our other income line items coming in right here before our operating expenses. I hope that answers your question, Omar.
Yeah, that's a great answer. Yeah, I'd just like to reiterate to anybody, this will be the last chance to ask any questions that you have. If you do need to ask any questions afterwards, you can always send an email to the address that I mentioned. Omar just said thank you very much. Thank you very much, Tarryn. So that's great. That seems to have answered his question. Also, this is the first time we've done a finance live class in a little while. So if anybody listening is interested in something specific moving forward that they'd really like to explore in another live class, we always really welcome that kind of feedback. So please do go ahead and pop it in the chat. Derek has asked a question. Hi, Tarryn. Thanks for your presentation. How do we look at it from business loan? I'm not sure if the wording there. Yeah, I don't know if you understand what he means there. How do we look at it from business loan?
From a business loan perspective, I'm going to just sort of take a little bit of a guess on what Derek's asking. And Derek, if I'm not answering you correctly, please question again.
Yes, he says. Yeah, he said. Sorry, I was typing quickly, but that's exactly right. Yeah.
Okay, so if us as a business, and this is often the case, we will need to finance our business in some way. And we can start looking at the capital structure of the business, which can be made up of debt and equity. So what a bank would do and what the credit team of the bank would do is they would have to see your financial statements, and they would probably need to see them over the course of about 3 years, assuming you'd been in business for that long. And what they're looking for is an indication of essentially consistent solvency and consistent liquidity, because what they don't want to do is lend you money that two things then happen. One is you can't service that debt. So in other words, you have insufficient cash flow and insufficient revenues coming into your business to be able to pay the interest, which is the concept of servicing the debt. And then ultimately, they obviously want you to be able to pay the debt back. So they need to know that over the debt term, maybe it's a 3-year loan or a 5-year loan or maybe even a 10-year loan, over that debt based on the performance of your business, and they would work through a whole lot of metrics to look at your interest coverage, leverage, what other debt you have, the kind of market that you're in, what sort of goods you're selling, what kind of revenue growth you're seeing. They would go through a whole sort of credit exercise to determine how much to lend to you. And in fact, the credit would also look at quite often the owners of the business, and there's sort of a character assessment. So they would look at the business itself, and they would also look at who is behind the business. And there would actually also be a determination on what is called the character of those individuals. Because at the end of the day, the business owner, in times of stress, will either prioritize the paying back of loan or the servicing of that debt through interest, or they will just say, actually, you know what, kind of shove it bank, it's your problem, not mine. And that speaks to the character of the individual doing the borrowing. So yes, financial statements, very important if you're applying for a business loan, because they tell the bank or the lending operation something about the financial health of your business over a period of time and the likelihood of you being able to service and pay back that debt.
Great. Thank you so much. We're just kind of approaching 5:30 now, GMT. I think with that, we shall call this webinar over. So thank you so much for that, Tarryn. It was brilliant. We're really very, very grateful. And for everybody listening, thanks a lot for joining us. And we shall be back next week. Our next webinar is an Excel-related webinar from Deb Ashby, who's been on here many times, and will be about pivot tables. So, thanks to everybody. If they'd like, I shall send an email out with the registration links to everybody, so they can join when they feel ready to. So, thanks a lot, everybody, and once again, thanks, Tarryn, and have a great week, everybody. Bye-bye.
Great. Thanks very much. Thanks for listening. Cheers.
Thanks, Tarryn. Bye-bye.